Kangmei Pharmaceutical told the world it was rich. Year after year, the company reported a mountain of cash in the bank, audited, signed off, repeated on every statement. Add up the cash Kangmei reported over those years, and you reach about 88 billion yuan, close to $13 billion. There was one problem with all that money. Most of it had never existed. It had been typed onto a balance sheet and backed by bank documents that regulators would later rule were forged. In some years, most of the cash on its books was fake. It became one of the largest accounting frauds China has ever seen, and it was hiding inside one of the country's most trusted companies. More than 50,000 ordinary investors had put money into that story. Most of them would never read a balance sheet up close. They didn't need to. That's the whole point of audited accounts. When a public company says it holds $13 billion in cash, and its auditors confirm it, you're supposed to be able to trust that. At Kangmei, you couldn't. And yes, the auditors signed off on all of it. We'll come back to the auditors later. Before any of this came out, Kangmei looked like one of the safest companies in China. Here's how it got there. The company was founded in 1997 in Puning, a city in Guangdong province in the south of China. Its founder was a businessman named Ma Xingtian, who built the company with his wife, Xu Dongjin. What they sold was traditional Chinese medicine, herbs, tonics, and remedies that people across China had used and trusted for centuries, now produced and sold at industrial scale. It was a powerful idea, and it worked. In March 2001, Kangmei listed its shares on the Shanghai Stock Exchange under the ticker 600518. Over the next 2 decades, it grew from a regional producer into a national giant. It became the first traditional medicine company on China's main market to be worth more than 100 billion yuan. At its peak, in the spring of 2018, the market valued Kangmei at about 139 billion yuan. Ma was treated as living proof that an ancient trade could be turned into a modern fortune. In the eyes of the market, Kangmei was one of the safest bets in the country. There's an obvious question here. If Kangmei was really worth that much, why fake the cash it could have earned for real? Because the cash was holding up everything else. China's securities regulator, the CSRC, later set out how it worked. It was built in layers. First, Kangmei faked the cash directly. It created false bank deposit slips and forged bank documents, paperwork that showed large sums sitting in accounts where there was little or nothing. On paper, the balance grew. In the bank, nothing moved. Then it faked a business to match. The company produced forged vouchers for sales and activity that never took place, so the invented money would look like it had come from somewhere real. It also inflated what it actually sold. Between 2016 and 2018, Kangmei used forged and altered tax invoices to pump up its reported revenue. Regulators later put the inflated revenue at around 29 billion yuan, and the inflated profit at about 4 billion. The fake cash itself piled up year after year. About 23 billion yuan in 2016, almost 30 billion in 2017, more than 36 billion in just the first half of 2018. Add it together and you reach that headline number, around 88 billion yuan, that was never really there. And underneath all of it, money was moving out the back door. The CSRC also found that Kangmei's controlling shareholder and people connected to him used company funds for their own purposes, without telling investors. Some of that money was funneled into accounts that traded Kangmei's own shares. The company was using cash it claimed to be holding in reserve to deal in its own stock. The court that later heard the case found that Ma Xingtian himself organized, planned, and directed the scheme. This was not a rogue accountant hiding a few losses or doing some creative bookkeeping. It ran from the top. Quick side note while we're here, this one was a fun one to dig into and a hard one. Almost none of the good detail on Kangmei is in English. The real story lives in Chinese court filings, the regulator's own penalty notices, and local financial press like Caixin. If you like foreign fraud cases like Kangmei, be sure to subscribe. There's more coming. None of this stayed perfectly hidden. There was a warning, and it came years earlier. Back in 2012, doubts were raised about Kangmei. Critics questioned the value of its land and its assets, and suggested the books had been inflated. For a short while, investors got nervous. Kangmei's value fell by something like 6 billion yuan. Then it passed. The questions faded, the share price recovered, and Kangmei went back to being a favorite stock. Set that early scare next to what was coming, and it looked small. 6 billion yuan was a real drop, but it was less than a tenth of the fraud still being built. The alarm rang once, in 2012. Almost no one treated it as real. In the end, the thing that gave Kangmei away was its own cash. The money it claimed to be holding did not behave the way real money does. A company that truly holds tens of billions in cash acts in a recognizable way. It earns interest on that money. It has little reason to borrow, and when it does borrow, it does so cheaply. Kangmei did the opposite. It reported an enormous pile of cash, and at the same time, it borrowed heavily and paid out a lot in interest. The huge sum it said it was sitting on barely earned a thing. Real cash does not sit idle while a company drowns in debt. On the 16th of October, 2018, two analysts, Fu Yanlong and Lin Shiming, wrote the contradiction down. Why was a company this flush with cash borrowing like one that was broke? It was a simple question, and it turned out to be the right one. That same night, the CSRC pulled together a team to start checking Kangmei's books. By the end of December 2018, Kangmei reported it was under investigation. At first, the company refused to call it fraud. In April 2019, Kangmei offered an explanation for the missing money. It said there had been an accounting error. Nearly 30 billion yuan in cash, it announced, had been recorded incorrectly. An error. The market did not accept that for long. In May 2019, the stock was relabeled. It became ST Kangmei. ST stands for special treatment, the marker China's exchanges attached to a company in serious trouble, a public flag that it may be on its way off the market. The darling of Chinese medicine now wore a warning label, fixed to its own name, for every investor to see. In May 2020, the regulator finished its investigation, and its findings were blunt. The CSRC ruled that Kangmei had carried out fraud that was organized, premeditated, and systematic. It had run for years, deliberately, directed from the top of the company. The case was handed to prosecutors. The fall matched the size of the lie. At its height, Kangmei had been worth about 139 billion yuan. After the fraud came to light, that value dropped by roughly 90%, to somewhere around 14 billion. In June 2019, MSCI, the company whose stock indexes steer investment money around the world, dropped Kangmei from its emerging markets index. The foreign money that had flowed in started flowing out. And then there's the fine. For a fraud measured in tens of billions of yuan, the penalty the CSRC handed the company was 600,000 yuan. 600,000. Set that beside a company once worth 139 billion yuan, and the fine all but disappears. Make of that what you will. The real weight of the case fell in the courtroom. That is where Kangmei became more than a scandal. It became a precedent. In November 2021, a court in Guangzhou ordered Kangmei to pay about 2.46 billion yuan, roughly $385 million, to the investors it had misled. There were more than 52,000 of them. What made the ruling historic was the kind of lawsuit behind it. In 2020, China had brought in a new securities law, and with it, something the country had never really had before. For the first time, ordinary investors could sue a company as one large group, the way class action lawsuits work in the United States. But China built it differently. Instead of private lawyers chasing a payout, the case is brought by a government-backed body, the Investor Service Center, on behalf of every affected shareholder at once. And it works in the way that matters most for small investors. If you bought the stock and lost money, you are in the lawsuit by default. You're only left out if you choose to opt out. Tens of thousands of people who would never file a claim on their own were suddenly part of one. Kangmei was the first real test of that law. It is the case that opened the door. Days later, the man at the center faced his own sentence. A court sentenced Ma Xingtian to 12 years in prison and fined him more than 1,000,000 yuan. He, his wife, and another executive were barred from the securities market for life. His appeal was rejected the following January. And the auditors, remember them? The accounting firm that had signed off on Kangmei's books, Zhenjiang Pearl River, was held fully liable by the court, right alongside the company itself. Its business did not survive the association. The number of listed companies it audited fell from more than 100 in 2018 to 46 the next year, then to 2, and then to none at all by 2021. An auditor's whole job is to catch a fraud like this. This one approved it instead. That was the end of the firm. Surprisingly enough, Kangmei itself did not vanish. In 2021, it was restructured, with state-linked investors putting in capital to keep it alive. The risk warning label was eventually removed. By July 2024, the company was allowed to use its original name again, almost as if none of it had happened. The lesson, though, is simpler than the fraud that taught it. For all the forged slips, the fake vouchers, and the doctored invoices, what finally gave Kangmei away was the cash. It sat on the balance sheet by the tens of billions, and it earned almost nothing year after year in plain view. The answer was inside the company's own numbers the whole time, waiting for someone to ask why a rich company kept borrowing like a poor one. 2 analysts asked. That was all it took. 52,000 investors had trusted that number. This time, the people who faked it were the ones who paid for it. That's it for this one. If you got something out of it, drop a like. It genuinely helps the channel reach people who'd want this. Subscribe if you want more foreign fraud cases. And if you want to support the work directly, we're on Patreon, where members get new videos early before they go public. The link's in the description. Thanks for watching. We'll see you on the next one.